Good morning, ladies and gentlemen. My name is Ben Woodhams. I'm the Managing Director of Knight Frank Kenyan. Welcome to the Kenyan launch of the 15th edition of the Wealth Report 2021. This year, as the launch of the Wealth Report goes virtual, I've chosen Knight Frank's Singapore office as my virtual background. Nice, isn't it? The Wealth Report is an annual production by Knight Frank. It brings together the latest intelligence and sharpest insight into the issues that matter most to the world's wealthy, from real estate to an entire spectrum of other investments. We're pleased you could join us to get an exclusive look into the wealth and investment trends of ultra high net worth individuals around the world, the continent, and more specifically in Kenya. We have three speakers today, starting with Andrew Shirley, the editor of the Wealth Report, to give us a global analysis. Then we have Tilda Mwai, Knight Frank researcher for Africa based in Dubai, to share the African wealth trends. And finally, me, giving you an outlook on the Kenyan property market and the key market trends to look out for. So without further ado, let's start the presentations with Andrew Shirley to give us the key takeaways from the Wealth Report. Over to you, Andrew.
Thank you very much, Ben. Ladies and gentlemen, Shikamu from London. I can't tell you how disappointed I am not to be able to join you in Africa to share in person the findings of the 15th edition of the Wealth Report. My annual trips to Nairobi to meet you all have been the highlights of my year for over half a decade. But swapping the real for the virtual is just another part of this brave new world that we are all learning to live in. As documented throughout the report, behavioural shifts such as working from home that we thought might play out over the next 5 or even 10 years have happened in a matter of months. When it comes to wealth trends, we can't escape the pandemic. According to the results of our annual attitude survey of private bankers and wealth advisors, COVID-19 is by far and away the biggest current worry for Kenya's wealthier residents when it comes to creating and preserving their wealth. Unsurprising perhaps, as the latest edition of the Knight Frank wealth sizing model shows that Kenya's population of high net worth individuals, those worth over $1 million US, slipped by 22% last year. This compares with a global decline of just 8%. But, and it's a very big but, 96% of our respondents also highlighted opportunities in a post-pandemic world as the current issue that excites them the most. As I said earlier, businesses and our lifestyles are having to change more quickly than ever before, and those who spot the newest consumer trends and investment opportunities will reap the benefits. Our wealth sizing model predicts that over the next 5 years, Kenya's HNW population will bounce back by 46%. And it looks like many of the opportunities to create wealth lie at home. The attitude survey reveals that only 19% of Kenyan HNWIs are considering applying for a second passport or new citizenship. That compares with 39% of wealthy Chinese and a whopping 62% of Nigerians. So now let's talk a bit about property. Aside from our families, our homes, our safe havens, where we have spent so much more of our time over the past 12 months, among our most treasured possessions, how did they perform during 2020? Prime residential markets across the world displayed a surprising degree of resilience, and the pandemic led to stronger, not weaker demand. In many prime markets, our Prime International Residential Index, which benchmarks luxury residential prices across 100 locations, both cities and second home markets, provides us with a unique perspective as to how and where wealth is influencing property markets. Last year, some 2/3 of the markets that we track registered price growth, and on average, prices increased by 1.9%. That may not sound much, but it's above what we saw in 2019. Low mortgage rates, more fiscal stimulus measures, strong performing equity markets, changing commuting patterns and property tax breaks in some markets pushed demand. As a result, prices higher. Markets that responded decisively to the pandemic and saw their economies reopen in 2020 were among the top performers. Auckland in New Zealand leads the index, with prime prices up 18% in 2020, followed by a number of Asian cities, including the Chinese city of Shenzhen, as well as Seoul in South Korea and Manila in the Philippines. But with prices already on the slide in 2019 due to a drop in buyer confidence, 2020, unsurprisingly, wasn't the year that prime real estate in Nairobi bounced back, with prices dropping a further 4%. In many parts of the world, the standout trend in 2020 was the search for space, as the pandemic shone a spotlight on our homes and how we live. When asked which locations were becoming more popular with their clients, coastal and rural areas resonated most strongly with the Kenyan respondents to our attitude survey. But, and again, it's another big one, we believe the pandemic has created opportunities for cities to evolve into something better. One of the biggest opportunities here is well-being and sustainability, with cities responsible for an estimated 70% of global carbon emissions. They are primed to lead the way to a more sustainable future. The 15-minute city, placemaking, green cities, all of these concepts are gaining more traction, linking with the drive for a green recovery and to improve the health of citizens, which is more prominent than ever. Almost 20% of Kenyan high net worth individuals are planning to buy a new home in 2021. And Kenya is our most popular destination, followed by the UK, US, South Africa and Canada. We believe many of these purchases will turn out to be what we're calling co-primary residences, and the expectations in them, such as decent broadband, will be that much higher. This is just one of the 10 trends that we identify as having shaped property markets in 2020. What else lies ahead? We predict that the pandemic-induced residential mini-boom will continue throughout 2021. Seoul in South Korea leads our 25-city forecast for 2021, with Asian markets again expected to perform strongly. For London, 2021 is set to be the year annual price growth moves out of negative territory for the first time in 6 years. In Nairobi, we expect the price falls of the past few years to slow as buyers who have been sitting on the sidelines decide to commit. I think we can all agree that the past 12 months have been tough. Sometimes the light at the end of the tunnel has looked decidedly dim at times. So I'd like to end my presentation on an upbeat tone. Ever thought about buying your own dinosaur? How about a complete T-Rex skeleton for $31 million? Something shinier? What about this 15-carat purple-pink diamond for $27 million? You prefer reading? Maybe a first edition of Shakespeare's collected works for $10 million. Sports more your thing? Try out this pair of Michael Jordan's basketball sneakers for almost $500,000. Or maybe you just need a new handbag. This Hermes crocodile skin Kelly for a mere $444,000 could be right up your street. These record-breaking sales are just a snapshot of some of the auction results of 2020 that show that COVID-19 and its impact on live auctions hasn't dented the enthusiasm of those who collect what we term luxury investments or investments of passion. And they reveal just how eclectic 21st century collections are becoming, not to mention how much their owners are prepared to invest in them. As part of the Wealth Report's mission to help its readers keep track of the trends beyond their property portfolios, about 10 years ago we created our unique luxury investment index. This tracks the performance of 10 investments of passion, although sadly, before you ask, not sneakers or dinosaurs yet. But we do have an Hermes handbag index. For the second year running, it has topped our rankings with annual growth of 17%. With a strong collecting base in Asia, already used to buying via online auctions, the pandemic seemed to have little impact on this sector. Wine easily traded online, and the classic car sector, the antithesis of lockdown, and where many of the big deals are done privately anyway, also performed relatively strongly. But whiskey, however, took a rare step backwards as buyers shied away from the most expensive bottles. But it was the top end of the art market, most reliant on high-profile auction sales, that experienced the biggest COVID hit, with average prices down 11% in 2020. Sales volumes at the major auction houses fell significantly, and last year, for the first time in a while, no work sold for over $100 million. But that's not to say collectors weren't buying art, or that the auctioneers took it lying down. As the year progressed, buyers became more relaxed about bidding many millions of dollars for works of art they hadn't even seen, even via apps on their smartphones. Auction houses innovated and galleries prospered. Sales became less about single genres and more about themed collections of objects and statement pieces that would appeal to lockdown collectors looking to brighten up their homes. A new breed of bright young artists, including many from Africa, the so-called red chips, created waves. Collectors are now being driven as much by what they see on their social media feeds as established conventions or reputations. As with many aspects of our lives and businesses, COVID-19 has shaken up the world of art, introduced much-needed innovation to the sales process, and ushered in a new era of young, enthusiastic collectors. This is a generation that thinks very differently to its parents, not just about what it hangs on the wall, but about property, about investments, and about the environment, particularly climate change. Often all of these are inextricably linked by the thread of doing good, or ESG. COVID may have postponed the start of the new roaring 20s, but once the virus is beaten, as it will be, I think the future looks very exciting indeed. Thank you very much, and I really do pray that by this time next year I'll be able to be back in Nairobi for real, and not just on a screen. I'd now like to hand over to my colleague Tilda Mwai, who will take a closer look at some of the Wealth Report's findings from an African perspective.
Thank you, Andrew. Ladies and gentlemen, I trust that you're keeping well and safe from wherever you're joining us from. My name is Tilda Mwai. I am the researcher for Africa at Knight Frank, and I am excited to present you with our Wealth Report findings with a focus on Africa. Before we start, I'd like you to describe for me what 2020 meant for you in one word. And since we cannot do this physically, I would like you to do that in the comment section below. Now, I'm sure some of you used words such as Zoom, working from home, pandemic, or unprecedented. However you described it, we can all agree that it was not business as usual in 2020. In fact, you might be wondering, in the middle of a global pandemic and the related economic crisis, why should we be interested in the wealthy? Simply put, if we are to understand the market and asset performance, then the wealthy form a key part of that story. In fact, as we have observed, the global response to the pandemic supported the wealthy. These responses included global policy responses to the pandemic, such as benchmark low interest rates and government stimuli that pushed asset prices higher, helping fuel growth in the number of ultra-high net worth individuals globally. Regionally, and especially for Africa, we have seen ultra-high net worth population in 2020 grew by 4.6% compared to 2.4% globally. Now, as you can imagine, this growth is not uniform and it varied depending on the different countries. For countries such as Egypt, the number of ultra-high net worth individuals increased by 15%, and for countries such as Kenya, this number was down by 15%. Now, if we look ahead, Africa will continue to be a key part of the growth story in ultra-high net worth individuals. In fact, we expect to see the second biggest regional 5-year ultra-high net worth growth recorded in Africa by 33%. Countries such as Zambia and South Africa are expected to emerge as the lead countries, with Zambia expected to record 40% ultra-high net worth growth and South Africa 32% ultra-high net worth growth. Even more positive is the outlook for households earning more than $100,000 US dollars in income per year. It is, according to Oxford Economics, this growth is expected to grow by 139% over the same 5-year period. Despite its current economic downturn, South Africa will continue to be the wealth hub for Africa, closely followed by Nigeria. But what are the biggest threats to wealth accumulation? Through our attitude survey, COVID-19 was reflected as the biggest worry for ultra-high net worth individuals in 2021. For Africa, this was rated at 88%, and most of the ultra-high net worth individuals indicated that they expect the pandemic will continue to impact their wealth accumulation and wealth creation. For countries such as Kenya, domestic policy, tax issues followed quite closely in terms of wealth creation and accumulation. Further, as a result of the pandemic, we anticipate that the world will be less global, with 80% of ultra-high net worth individuals expecting to travel less in Africa. This is anticipated to result in an increased interest in the domestic market and increased domestic capital across the investment sector in different countries. But what does this mean for our cities? Now, there has been much rhetoric towards the future of the city, but from our perspective, we believe that the pandemic has just ushered in a rebirth of the city. Trends such as the 15-minute city are trends that are picking up and gaining momentum. Simply put, the 15-minute cities just means that residents are able to work, live, and play within 15 minutes of where they live. And so, while this is a trend that was definitely accelerated by the pandemic, it is a trend that we had continued to see even pre-pandemic with the emergence of smart cities across the continent. And we expect that this will continue. Now, in fact, 36% of ultra high net worth individuals indicated that they are likely to purchase a home in an urban area. This might not look like much, but if compared to other regions, then you can definitely see the difference. For UK, for example, only 6% expressed interest in urban areas, and Latin America, this was at 7%. As a result, in order to know where our cities rank, we have built our Knight Frank City. We have built on our Knight Frank City Wellbeing Index from 2019 to create a Knight Frank City trifecta by including factors such as innovation and quality of healthcare. As a result, Johannesburg emerged as the top city, followed by Cairo, Cape Town, Nairobi, and Lagos in that order. Compared to last year, we did see Nairobi move a slot up to factor in for innovation that has been picking up in the city. But what does all this mean for investment? If you look at property, and specifically for commercial property, investment in commercial property has remained stable. As indicated in our attitude survey, 25% of ultra high net worth individuals are likely to invest in commercial property in 2021 across the continent. Kenya, however, ranked below the regional average at 19%, and perhaps not surprisingly, since the market was already subdued pre-pandemic. As with last year, alternatives remain key. And as you can see, 24% of ultra high net worth individuals are likely to invest in healthcare, with retirement homes expressing 21% interest. But perhaps not surprisingly, there is also equal interest in mainstream real estate across Africa, with 20% of ultra high net worth individuals likely to invest in retail and 19% likely to invest in offices. But the main takeaway from the pandemic is that it has fast-tracked real estate innovation. Elements such as ESG and PropTech have taken center stage, with 42% of investors increasingly interested in ESG investments and 41% indicating that they're interested in ESG in Kenya, with the recognition that it is good for business and it is good for them. In conclusion, we can all agree that the pandemic has created significant disruption across different sectors in various markets. But we have also seen numerous opportunities emerging. Opportunities in innovation and investments are some of the things that we have highlighted in this report that we expect we will continue to see in 2021. So thank you very much, ladies and gentlemen. I will now hand over to Ben.
Thank you very much, Tilda. That was excellent, a fascinating insight into the more African aspects of the Wealth Report. I'm here to talk about Kenya specifically in our property market. So I'll touch on the economy and then I'll move through the various sectors. Okay, so in the economy, basically Kenya's economy contracted by 1.1% in 2020. So a big contraction. GDP hit massively by the pandemic, but it's expected to rebound to 6.9% in 2021. That's a huge rise, but don't forget, quite a lot of that is carried over from 2020, way above the sub-Saharan African growth that is projected generally at 2.7%. That's because the reopening of the economy and the government's implementation of economic and fiscal policies. I think the Kenyan government's handled the situation very well, didn't close down too much, so it's enabling us to reopen and get going quite easily. The value of Nairobi's building approvals fell by 25% in 2020, so a big contraction there, with investors adopting a wait-and-see attitude. But cement production and consumption remain the same. Why? Because of infrastructure projects, the huge amount of infrastructure development that's going on, such as the Nairobi Expressway. The retail sector was one of the hardest hit sectors. So the second quarter, footfall was way down. In the third quarter, we started to see some recovery, and in the fourth quarter, better as we moved towards the holiday season. So basically, footfall, people were not leaving home, not going shopping, and literally only going out of their houses for the bare basic essentials. So whilst the anchor tenants were doing okay, those line shops that were relying on impulse purchases saw a huge reduction in footfall, and many of them actually simply closed. They needed a lot of help, and we had to do rental concessions to help them survive. The vacancies are still high in retail. Challenges faced by major retailers caused by the pandemic. Vacancies are still very high in retail. The challenges faced by major retailers caused by the pandemic primarily reduced consumers' disposable income. So you've got less money in your pocket, you've got less ability to go shopping and buy stuff, and so ultimately those guys are suffering quite badly. Even today still, although we saw a big uptake of demand towards Christmas, we are still seeing some major problems in the retail sector. In spite of this, some retailers remain bullish with expansion plans, especially within neighborhood centers. So that is to say, not exactly moving away from the malls, but preferring for the new developments, more sort of line shop, convenient style retail outlets within the residential areas themselves. The office sector. So prime office rents dropped by 13% in 2020. That's quite a big drop. And occupancy levels for commercial space at 72%. So much higher vacancy, for example, back in 2016 when they were at 90%. The absorption of new office space decreased by 47% in 2020 compared to similar period in 2019. So what we're seeing there is office occupiers obviously delaying expansion plans, but also a lot of people working from home as well. And so tenants not renewing their leases in 2020, again, playing a wait and see game there to see how the situation will pan out. Offices is one of the sectors that I think will probably be disrupted the most, and we can talk about that in much more detail. The way the office will be used will certainly change over the period of 2021 going forwards. So, still in offices, the key themes that will continue into 2021. Oversupply will continue to have a downward pressure on rentals. What we're trying to do at Knight Frank is convince our clients, don't simply reduce your rent. Whether it's a lease renewal or a new tenancy, if you set your bar during the pandemic, you're going to live with that throughout the whole life of the lease. If you're persuading a tenant to stay in your building or encouraging a new tenant to come into it, give them a short-term benefit, perhaps a longer rent-free period or something like that. Because once that's gone, it doesn't have any impact on the property. If you want to let the property at 120, don't say, okay, come in for 80 shillings a square foot. Keep it at 120, but give them a 3 or a 6 month rent-free period. And then once that's gone, the value of your building is not affected because valuers don't look backwards. No one's interested in the past, they only look forwards. So keep the rent higher, but agree a concession that's short-term. The disruptors in this sector, people working from home. Obviously, we've seen a huge amount of people working from home now, which is fascinating. And I think we'll see that continue as we go into the future. Downsizing of space by existing tenants as a result of that. At the moment, they're not going to do that because they need the excess space to maintain social distancing within the office space. But once we're through that issue, then we're going to be looking at tenants wanting to consolidate and downsize as they have the new work-life balance changing and office workers being able to come to the office perhaps only 2 or 3 times a week. So we're shifting towards a flexible workspaces and occupiers developing a hub and spoke model whereby you've got people working from home, coming in, sharing desks and so on and so forth. Of course, we can't do sharing desks at the moment because of social distancing, but that will certainly become much more relevant in the future. So as I say, that excess space that they've got now, useful in the short term for social distancing, but in the long term, they'll want to contract. But don't think that that's going to see a huge contraction in the office market because obviously Nairobi is a regional hub and we will have other people coming in to occupy that space that's surrendered, but also landlords and employers are much more focusing now on wellness, and so there will be additional space required in that office for breakouts, for socializing and that kind of thing. So they will want more space there, definitely. Serviced offices, a subsector, fascinating within the office sector. What we've seen there is in March, everybody walked away from the offices. So those of them who were in serviced offices didn't have long commitments could simply walk away from that space. And so serviced office providers suddenly found themselves with empty space. Obviously, within an office building, you have a 6-year lease. And so you have a longer commitment that you can't simply walk away from. But in serviced offices, they were empty almost immediately. So those guys really suffered. But the shoe is now on the other foot. As we come out of the pandemic, occupiers want that level of flexibility. And so the serviced office providers are actually doing really well, and they're recovering much, much faster than other office occupiers. And so I think we'll see a bigger growth of that sector. And there is lots more co-working, serviced offices. That's a very busy sector, and I think we'll see that continue. Again, don't forget, office occupiers have long 6-year leases, so there's going to be no rapid changes. The market is slow to react, long leases, and so those changes will happen over time. Moving on to the residential sector, prime sale prices dropped by 4% in 2020, but prime rental prices dropped over 10% during the same year. And I think we've seen that impacting across the whole market, right from low-cost housing up to the super prime. So sales not as badly affected as rental levels. And again, that's partly because the rental market is very dynamic and very quick to change, to respond to change. The mortgage market remains subdued, with 28,000 mortgages in 2019 compared to 26,500 in 2018. So a very slow growth. But in spite of reduced lending rates, and don't forget, we've got a population of almost 48 million people in Kenya. So the mortgage market is absolutely tiny. So with a national housing deficit of approximately 2 million units, investment in affordable housing remains steady, primarily from government. So that's one of the 4 pillars of government is affordable housing. So I think we're going to see continued interest in that sector at the bottom of the market. Also, another subsector, student accommodation, continues to be buoyed by our youthful population, our high percentage of the youth attending universities and secondary, tertiary education. And so that is a market that I think we're going to see lots of investment in the future as well. Kenya has a median age of 21, so young population, lots of people at university, student accommodation will be a growth sector for sure. Moving on to the industrial sector. Globally, this has definitely been the most resilient sector, and it's also true here in Kenya, but for slightly different reasons. Institutional investment continuing along major arterial nodes, Tilisi, Tatu City, those kind of developments, making use of the new infrastructure, developers continuing to shift to A-grade warehousing, so moving out of the old colonial warehousing into new modern space with duct levelers, high eaves, and so on and so forth. We have over 4 million square feet of industrial space in the pipeline in and around Nairobi alone. The trends that have driven that demand during the pandemic have included self-storage, cold storage, data centers, but not so much online retail. So where you've got your Amazon package being delivered every day in places like the US and the UK, we don't have that last mile delivery yet. And so as a result of that, the online retail hasn't really taken off here as much as it has in other parts of the world, but it will, given time. Hospitality, the tourism and hotel sector. This, like everywhere in the world, is by far the hardest hit sector, with an estimated loss of 110 billion shillings in 2020, with several hotels simply closing operations and some investors opting out. Tourism arrivals fell from 2 million in 2019 to less than 500,000 in 2020. So we're down to a tiny proportion of that foreign income revenue that was coming into Kenya, with a consequently devastating effect on the hospitality sector. And that's also been exacerbated by the fact that there's been no conferencing, which is another part of the economy that drives that sector. So double whammy there, massive impact on the tourism and hotel sector. Average occupancy levels were in the region of 20% in 2020. So occupancy right down. And as I said, many of the hotels simply couldn't make ends meet and thought, well, let's close for now, send everybody home, and we'll have another look at it in 2021. So very few hotel completions in 2020, with investors preferring to push their openings to 2021. So they were going to open in 2020, thought this is really a bad time. Let's just pause, put everything on ice, and then in 2021, when the market opens up again, we will have another look at opening then. So because of those delays, we're looking at an estimated in excess of 1,000 keys to be released in the Nairobi market alone in 2021. Business travel will continue to suffer in the long run. Operators will continue to focus on domestic travel. So those hotels that are operating in Kenya are now saying, okay, fine, we're not going to get our foreign travel. Let's really focus on domestic. So people living in Nairobi, going on holiday to the coast and up country, that is what is driving the tourism industry at the moment. So recovery in the sector really will be subject to a lift on international travel restrictions, and it will depend on infection rates, vaccine rollouts, and how the operators can ensure client safety.
Thank you to the speakers for preparing those fascinating presentations. That last presenter really knew what he was talking about, didn't he? Very impressive. I hope we've given you a new perspective on the behavior of ultra high net worths, not only in the country, but in Africa and across the world. When you registered, you were given the opportunity to submit questions. So we received a number of those when you did register, and we've picked out a few to answer today. At this point, if you'd like to submit any further questions, you can do so by clicking the Ask Question button on your screen. We won't be able to cover those today, but we will send you an email response with the answers to you. Right, the first question I have got is why are we talking about wealth in the middle of the pandemic? I'll answer this one, and I think this is a question that we've been asked by journalists as well, and it's really the wealth report is not a celebration of wealth. It's really to help us understand what the wealthy people are doing, what decisions they're making. People have got wealthy because they make good business decisions. So now more than ever, we need to understand what those decisions are, how they've got to making those decisions, and what's the thought process behind them. And I think the wealth report really helps us get there. Andrew, I don't know if you want to add anything to that.
Thanks, Ben. Yeah, you're absolutely right. It's not a celebration of wealth, but the decisions of the wealthy impact on so many things around the world, whether it's property markets or share prices, that kind of thing. I mean, you can just see the world hanging on Elon Musk's every word these days. So, what the wealthy do have ramifications for everybody else in the world.
Absolutely. Thanks for that. Okay, another question. How is Kenya performing compared to its East African neighbours in terms of high net wealth individuals? Tilda, that one I think probably best answered by you.
I think compared to the different East African nations, I think you will notice that for Kenya, high net worth individuals' wealth declined compared to countries such as Uganda, which recorded an increase in ultra high net worth individual wealth. So I think that also tracks back to the performance of the economy, where we've seen that the Kenyan economy was quite subdued over the past year, and that went on to reflect in terms of the ultra high net worth individual wealth. And you notice that for a country like Uganda, because for a period there, they sort of had the pandemic in control and also recorded quite positive growth. And so that reflected in terms of their wealth numbers. So not too great, but also not too bad. Yeah.
Okay, great, thank you. Right, another one here. What is your key takeaway from the report this year? I think that one's definitely got your name on it, Andrew.
Thanks, Ben. I mean, I think the whole report is set against the backdrop of the pandemic, and we can't minimize that. It's had a huge impact on many of our lives, but I think we need to stay positive. And what we've seen throughout the wealth report is that some of the long-term trends that were developing anyway, things that might have happened within 5 or 10 years, have actually been supercharged by the pandemic. And they've happened in a couple of months. The working from home thing is just one of them. You presenting from Singapore today is just another. So what we've seen is the pandemic accelerate trends that were happening, and alongside with that, we've seen a lot of innovation happening in terms of the tech sector, and I think that brings a lot of opportunities for the readers of the wealth report. It was interesting that when we did our attitude survey, although people were pessimistic about the economic impact of the pandemic, they were also quite optimistic about the opportunities that the pandemic would bring. So I think that's the thing that stands out for me from the report, that we're starting a new era, and there are going to be opportunities coming out of that.
Yeah, I think it's been like a reset for everybody as well, really, hasn't it? It's got people thinking about much broader issues, which is fascinating to see. Right, next question. What is your long-term view on the property market here in Kenya? I think I'll take that one. I always say that Kenya Nairobi specifically is a regional hub, and so Kenya is really the powerhouse of the region. So I think, slightly contrary to what Tilda just said, I think that Ugandan lockdown was actually quite hard. It did control the spread of the virus, but at the expense of the economy. I think Uganda suffered economically quite badly as a result of that. Now, perhaps that did give ultra high net worths different opportunities to increase their wealth, because with change comes opportunity. But I think that the Kenya lockdown wasn't as severe, and I think the economy was somehow preserved more in a way that's going to help Kenya come out of this quicker than some other countries in the region. So I think the long-term view of the property market here in Kenya is quite buoyant. It's quite positive. It's, as I've said before, it's a two-tier property market. We have the national property market and the regional property market. And because we're a regional hub, we will continue to see continued demand from regional operators here, driving the need for office space in particular, but property generally. So question number 5, why was there a growth in ultra high net worths globally in 2020, a pandemic year? So Andrew, I think maybe you've sort of alluded to that previously, but you think if the world is in economic turmoil, every single economy around the world is crashing as a result of the pandemic, how are people getting wealthier against that backdrop?
It's a good question, but actually, if you look at some parts of the world, their economies didn't crash. If you look at China, for example, they're going to have positive GDP in 2020. Taiwan also. It's that. It's Asia where we've been seeing this really strong wealth creation over the past 5 years or longer. And those are the countries that really tackled COVID the most effectively. So for much of last year, actually, China's economy was continuing to grow, as was Taiwan's. You look at Vietnam, very few COVID cases there. South Korea, these are the countries that got a real grip on COVID. And as a result, wealth increased in those countries because they are, that part of the world is so important to global wealth creation. Actually, it sort of nudged the total number of ultra high net worth individuals around the world last year ever higher.
Fascinating. That's amazing, isn't it? I guess, as you say, those countries that did handle it well are in a position to perform so much better when all the other major economies in the world are suffering so much. Okay, next question. What are the opportunities in the growth of the mass affluent in Africa? I think, Tilda, that one's definitely for you.
I think the opportunities, Ben, are not new, but we are likely to see an increasing trend towards them. And that's really in the alternative real estate sector, where we have seen, obviously, over the past year and previously, there was increased interest in healthcare sector, in the residential sector, especially for affordable housing, for student housing, and for sectors such as agriculture. So these are sectors that we expect will continue to grow. Of course, the growth of the mass affluent also means that outside of real estate, then opportunities in fintech and also opportunities for innovation will continue to be massive, especially for Africa. And these are opportunities that have been lauded as ways for Africa to leapfrog its existing challenges. So I think this is a trend that we will continue to see being influenced by the growth of the mass affluent.
Excellent, thank you. Next question. High net worth individuals are investing more in healthcare. What opportunities are they noting? So why the interest in healthcare? I think, Tilda, that's probably another one for you, please.
I think over the past year, of course, the pandemic was a healthcare crisis as much as it was an economic crisis. And that really served to eliminate some of the capacity gaps that are existent in Africa and even the world over. And also ways in which the private sector can come in and also invest in healthcare. I think we've also seen governments quite keen on public-private partnerships. And for the first time, one of the things that we are seeing, especially for Africa, is that there is availability of data. Previously, we did know to the extent to which these gaps are existent, but because of the pandemic, there has been quite a lot of data that has come to the light, just so that people can understand the extent of these infrastructure gaps that are existent. And so probably that is why there's an increasing need and an increasing affinity towards investing in healthcare, and that trend is likely to continue moving forward.
Great, thank you. Right, the next question, excuse me. What is the impact of the property market post-pandemic? I think that's a reference to the Kenyan property market, because that question came from one of our Kenyan clients here who is an owner of property. And I think it's a fascinating subject, and it probably varies sector to sector. But if we were to look at offices, for example, you know, a lot of people have said, well, surely the office market is dead, everybody's going to work from home now, and so on and so forth. You know, that's something that I love talking about, because it's obviously there's no real answer to it, but it's a complex question. And I think, yes, people are going to spend more time working from home. I think the lessons that we've learned is that there's a lot that can be achieved that you don't have to be in the office for. There's certainly a lot that can be achieved you don't have to travel around the world for. And so there will be some major disruptions in the office sector with people working from home. But I think the office is still very important. And we've already seen that come about. Large companies, I think it was Twitter who said from now on everyone's going to work from home, and already they've got people back in the office. So already starting to see people come back into the office. And I think it will be a blended solution. It's very important for people to save time, not sitting in traffic, commuting, or working from home where they can. But it's also important for them to have an interface with their colleagues, their peers, and their line managers, and so on and so forth. So that will continue to happen. What that means is those organizations may need less space than they have now, but that excess space that they have at the moment is very useful for getting people back in the office and yet maintaining social distancing between them. And I think as we go forwards, yes, they will perhaps need less space, although they will need more space for some of the wellness aspects that that employers will be looking at now. So looking at wellness is a more important factor. So getting their staff to have a better experience in the workplace. But also, yes, there will slowly be a reduction in office space by those current occupiers. But I think in markets like Nairobi and other growth markets, that will be more than offset by new occupiers coming into the market. And office leases are long, so this won't happen overnight. Where one company wants to downsize, it'll have to wait till the end of its lease in order to do that. So it'll be a gradual transition as these things change, not a dramatic change. And I think for the rest of the market, we're already starting to see it picking up post-pandemic anyway as the economy returns to normal. So I'm not particularly afraid of the future. I think the future for Africa generally and for Nairobi in particular is bright. Okay, so I think we've probably got time for one last question. And so what I've got here is, what would be your message to readers of the Wealth Report in Africa? And I think, Andrew, that one has to be for you.
I think it's a really positive message, Ben. As you know, I've come up to Africa for quite a few years to launch the Wealth Report, and I'm always amazed by the level of entrepreneurship that we see in Kenya and other African countries. And given, as I said before, now is a time for change. It's a time for new ideas. I think Africa is really well positioned to seize the moment. We're seeing a new global order. China and the US perhaps not getting on so well. So it's a really good time for Africa to position itself, in the middle of this global reset and take advantage of that.
Great. Okay, thank you very much for that. I think that's probably all we've got time for in terms of questions. But what I'd like to do now is move on to wind things up. Just bear with me 1 second while I transition. Okay, so yeah, before we do end, you'll see a red button on the left of your screen below the video window. That button will take you to the dedicated Wealth Report 2021 webpage, where you can download the Wealth Report, which will be sent out to you after the event. Our global team will also be hosting monthly webinars to discuss key insights from the report further. These will focus on prime property, global wealth, commercial property, and luxury investments. You can register to attend any of those by clicking on the blue Book Your Space button below. So I'd like to give a vote of thanks to various partners who've made the 2021 Wealth Report and this event possible today. So to start with, I'd like to say a big thank you to the 21 private bankers and wealth managers from Kenya who took part in the attitude survey. These financial advisors come from NCBA Group, ICA Lion, Stanbic Bank Kenya, Genghis Capital, and Dry Associates. And without them, we wouldn't have been able to draw out the Kenyan numbers and analyze the behavior and investment trends of the high net worths here in Kenya specifically. I'd also like to thank Palestinian Interiors for providing the venue for us to film the presentations you just watched. And also thanks to our speakers and all the Knight Frank contributors globally who make the Wealth Report what it is. Most of all, I'd like to thank you for attending this event and for your continued support as clients of Knight Frank. As we celebrate our 125th anniversary in 2021, this is a milestone that marks a collaboration between Knight Frank and our clients worldwide. Thank you very much.